Hi, my name is John Bailey, and I'm an advisor here at Amuni Financial. I'd like to take a few minutes to discuss a few of the safe, short-term, but higher yield investments that allow you to stay liquid but earn a meaningful yield at the same time. These investments are a great alternative to leaving cash just lying around in a savings account. This can be particularly useful for individuals that have had a recent liquidity event, for example, the sale of a business or property, and business owners with working capital. For the past several years, most short-term investments provided less than 1% annual return. At that rate, it was barely worth the hassle to invest. At the same time, inflation was at a very manageable level, so sitting on cash for future purchases was a reasonable choice. However, the interest rate landscape has changed dramatically. The rise in interest rates has brought some new challenges, but it has also provided some new and very exciting investment opportunities. There are now relatively safe, short-term investments that currently provide close to 5% annual return. Between record high inflation and higher short-term rates, sitting on cash is no longer sufficient. For every 100K that is left sitting in a savings account, 5K is being left on the table annually. For individuals and businesses sitting on large piles of cash, this can add up in a hurry. There are a variety of investment opportunities that can be considered. A few that we like for our clients are treasuries, CDs, municipal bonds, and money market funds. The best choice for you will depend on your investment objectives and tax bracket. For most investors, it's hard to go wrong with treasuries. Your entire investment is backed by the full faith and credit of the United States, which is why the risk-free rate, which is commonly used in financial models, is based on U.S. Treasury rates. CDs are only FDIC insured up to $250,000, which can result in having to split monies between multiple different CDs to diversify credit risk. Another plus for treasuries is liquidity. The bid-ask spread on treasuries is very tight, which allows us to sell your bonds at any time during market hours at the market price. Right now, 6-month to 5-year treasuries are earning close to 4.5%. Don't let that time frame fool you though. You can buy or sell any maturity whenever you like. However, if you plan to hold for a longer period, you may want to lock that rate in now by buying a longer maturity. The income frequency for treasuries will depend on the structure of the bond, but typically these pay semi-annually or twice a year. CDs, or certificates of deposit, are another great choice for short-term investment. CDs are basically short-term loans that you give to a bank instead of the other way around. Once you give the cash to the bank, they will pay you interest until you either redeem the CD or it matures. Current CD rates are as high as 4.5% to almost 5% right now. As we mentioned before, these investments are FDIC insured up to $250,000. The nice thing about brokered CDs that we buy for our clients is they do not have a lockup period. Often, when CDs are purchased directly from a bank, there's a holding period. The investor may have to pay a penalty if they redeem their CDs before the lockup period ends. Brokered CDs can be sold at any time during market hours. And although they are very liquid, the spread is not as tight as with treasuries. This means that a very small portion of the investment may be lost if the CD is not held to maturity. CDs can either pay interest monthly or semi-annually. Munis offer an interesting opportunity for those in a higher tax bracket. Short-term munis are currently providing close to 4% annual return. Although this sounds low compared to the previous investments, there's one major difference. That 4% is completely tax-free. A simple calculation shows that someone in the 35% tax bracket would be getting a tax equivalent yield, in other words, what they'd have to get from a treasury or CD, of over 6%. This is the clear winner from a yield standpoint for those in a higher tax bracket. However, munis are not as liquid as treasuries, although they are very easy to sell at any time during market hours. The security of your investment will depend on the underlying credit. Some munis are backed by the full faith and credit of a particular state. Some are backed by specific projects, and many carry an additional layer of insurance from companies that specialize in insuring municipal bonds. Munis typically pay interest semi-annually. The last option I'd like to touch on is a money market fund. Money market funds trade like a stock. This makes them the most liquid of all options. However, they provide the lowest return. Current money market funds are providing around 2.5 to 3% annual return. However, they're the best option for someone looking for a place to park cash for less than a month or so. Money market funds are a very safe mix of other short-term investments, treasuries, CDs, short-term corporate bonds, etc. And money market funds typically pay interest monthly. I'd like to wrap this up with a quick summary of the highlights of each security. Treasuries are considered the safest. CDs or munis may offer the highest returns depending on your tax bracket, and money market funds are the most liquid. If you'd like to discuss any of these opportunities with an advisor, please give us a call at 1-800-868-6864 or shoot us an email at advice@amuni.com. We would be happy to go over your particular needs. You can also find more information about us and our services on our website at amuni.com. Thank you for watching, and if you like this video, please don't forget to subscribe. Have a great day.